All right, well, let's get started. So the webinar today will cover the rise of crypto futures, a topic we have been looking at closely here in Into the Block. First, we'll give a brief overview of the history of traditional futures and some indicators that are used to trade futures. As well, we'll dive into crypto futures specifically, the overview and how it's grown through the years, and how here at Into the Block, we're applying our data science framework to look at crypto futures. Before that, however, two things. First, if you have questions, feel free to ask through the Q&A. I'll keep an eye on it, and the team will also be answering as I speak. And we have a very special announcement. As of 1 p.m. Eastern Time, so 1 hour from now, you will be able to see us in CoinMarketCap. So this is something that we have been excited and working on for last few months. They will add an on-chain analysis chart within the coin that you choose, and this will be available for all the tokens provided into the block. Okay, without further ado, let's get started. So first, I'll go over the basics of futures in traditional markets. Essentially, a futures contract is a contract where a buyer and a seller agreed to buy a contract for an underlying asset at a future date, which is known as expiration date at a given price. The first futures contracts were trading during the 17th century. The first official futures contract was for tulips during the tulip mania in the Netherlands. And the first official futures exchange was the Dojima Rice Exchange in Osaka, which served the purpose of helping samurais who earned their income in rice to hedge their risk of bad harvests and depreciation in their income. As you may know, this has grown to a significant market nowadays. It expanded into metals in the 19th century and beyond commodities in the late 20th century into currencies and stocks, of course. Excuse me. So what are futures used for? Well, they serve the demand to be able to profit from an asset without holding it. They're able to they're used to hedge your risk, or essentially just manage your risk against the price movement, and to get access to hard to trade assets. So for example, there's weather derivatives and futures traded in the CME exchange. And there's two main types of futures. There's cash settled and physically settled. Cash settled, essentially at the expiration date, you just receive the money equivalent of the amount exchanged in the contract, whereas in the physically settled contracts, you actually receive the good. So it's mostly used for commodities. So if you buy a physically settled gold future, you would actually end up receiving the amount of gold that you agreed upon in the future contract. The current state, well, it's an understatement to say that futures volume is greater than spot volume. So futures is a part of derivatives, and derivatives encompass over 1 quadrillion market cap. So it's definitely grown a lot significantly, and we expect this to be the case for crypto as well, for crypto futures and derivatives. So what are some of the traditional futures indicators? Well, of course, the futures price is the one most people look at. It's essentially just a price the two sides of the two parties agree to transact the contract. There's the volume, which is traditionally in traditional markets, it's measured as number of contracts traded per day. And it can also be measured as the dollar amount traded. And there's the open interest, which is the number of outstanding contracts, essentially the number of open positions. For people who are maybe new to the space, this exercise is a good way to explain the difference between the two. Essentially, imagine that one trader purchases 10 contracts, then the volume increases by 10. That person is long 10 contracts, so their open position is 10 contracts, right? Then they decide to close 3 contracts, then the open interest in this market, which is composed at this moment of only one person, would drop to 7, but the volume would also count that 3 contract closing transaction. And if another trader decides to open a position, in this case a short position, they sell 4 contracts, then that would increase the open interest by 4, but also increase the volume by 4. Other slightly more advanced traditional futures indicators include Contango, which is essentially when the futures price exceeds the current spot price, and backwardation, sometimes known as normal backwardation, which is the opposite, when the futures price is lower than the expected spot price. Basis is just the difference. So the area under these curves, between these curves, I should say, and turnover is the volume divided by the open interest. So let's get into the main area of interest for us here. How do these apply to crypto futures, and how has this industry grown overall? Well, since crypto futures started, probably around 2014 when BitMEX launched, we have seen and a lot of media attention and also growth in volumes and institutionalization in the futures market. Another parallel, it's that the official, first official futures contracts were launched in the mania phase of Bitcoin, so 2017, similar with Tulip Mania. It's a sign of institutionalization. The chairman of CME famously said that they will tame Bitcoin. I don't know if they've actually achieved that, but they've definitely profited from their futures contracts, as you can see from this chart above. The 2018, many analysts have believed to be the inflection point for futures. So as the regular exchanges, not all of them offered an option to short Bitcoin. This became a more popular way to short Bitcoin, just essentially through futures, opening a short position. And a lot of exchanges, particularly CME, doubled their average daily volume. And in some of the non-regulated exchanges, this increase was even 6 times greater than what it was in 2017. So it's definitely a growth in the industry, and we've continued to see the trend in 2018. 2019 was the year where crypto exchanges decided to join the party. So they see this large amount of growth, and the incumbents essentially decide to join. Bitfinex in January, Kraken in March, Binance in September. And the interesting thing is we're seeing the same patterns that arise with traditional markets. Derivatives have overcame in all of these exchanges spot prices. So at the moment, in just 3 months, since the launch in Binance futures, they're 3 times, so 75% of the volume traded in Binance, which is one of the largest cryptocurrency exchanges, as you may know, is just futures trading. And this is a trend that it's seen across the market, and we expect it to continue. So there's 2 types of futures contracts, same with traditional markets. Most of them are cash settled. Backed is really an exception, even though they've had a lot of hype in the media. They decided also to launch their own cash settled versions of the futures. And as you may know, they're associated with high leverage, even though you necessarily need to have high leverage. But if you do, that's definitely, you need to know there is high risk associated with trading futures and any derivative for that matter at high leverage. And there's the conventional contracts, which essentially have an expiration date, the settlement date. And there's the new types of contracts, completely new to crypto, which is perpetual swaps. So this is because crypto markets are 24/7. So they decided to have a new type of contract that's the nature of crypto. So it has no expiry dates, traded 24/7. And you may be wondering, so if it's constantly traded and it doesn't expire, how do prices have an agreement? So there's no large difference between the price in the perpetual swap and the price in the spot prices. So they're pushed essentially towards the spot prices through the funding rate, which is this fee essentially that is charged to long or short holders, depending if prices are a premium or discount. So how does it work? Well, every 8 hours, that's usually the amount that exchanges use, and it's only used in non-traditional exchanges. Every 8 hours, the long holders, if it's at a premium, pay the short holders that funding rate, which is usually a small amount. Here you can see 0.05% or so. It's increased this year. And essentially, it's been an indicator that's been closely followed in crypto, since it's an indicator that tracks how the market is positioning. So if the funding rate is above 0, essentially what it means is that there are more people, more volume, should I say, it's being long on Bitcoin right now. So it's definitely an indicator that we have been following closely here at Into the Block, and we will come up with some interesting indicators I'll talk about soon. Just as there's two types of contracts, there's two main types of exchanges trading futures contracts. There's the non-regulated ones and the regulated futures contracts. There's been a large difference between volumes and open interest in these two exchanges. So BitMEX, which is the first or second, depending on the month, in terms of volume on the non-regulated exchanges, is about 6 times greater volume, 8 times greater in open interest, comparing the perpetual swap versus the front-running contract. And if you compare the March futures that both expire on March for BitMEX and CME, it's still several orders of magnitude above CME, which is the largest regulated futures exchange for crypto. And do keep in mind that one of the reasons that why volume is so high in non-regulated versus regulated is that volume is a function of leverage. So BitMEX is famous for having 100 times leverage, which translates to the inverse 1% maintenance margin. So essentially, you need 0.01 Bitcoin to buy one Bitcoin contract, futures contract, and in CME, it's the opposite. You need 0.7 BTC to buy one BTC. So this would translate to less than 2x leverage. So I'll go over the approach that we have been used at Into the Block to analyze the growth in crypto markets, in crypto futures, and in derivatives as a whole. So at Into the Block, we have 3 main pillars that we use to analyze the data we provide in our platform. Essentially, we use data science and machine learning and on-chain analytics factors that help us to build more sophisticated futures analytics, metrics combining blockchain info with futures data, and indicators tailored to the nature of crypto futures. So with this in mind, we're building novel adaptations, should I say, of what's currently available in traditional markets. So we're not just using the Contango backwardation models. What we're doing is analyzing the changes in the basis. So remember that the basis is this difference, a premium or a discount. And so in theory, the basis should converge towards spot prices over time. But what we're noticing is that crypto being a nascent asset class, that's not always the case. And these divergences can actually tell us a lot about the behavior and the expectations that the market has about a crypto future. So what we're doing is applying our machine learning and statistical models to create a bullish bearish signal, like the ones you can see in our quick view page, to create a signal on how spot and future prices converge and what they tell us about expectations in the market. We're also building a futures market momentum indicator. So what we're doing is also adapting this well-built framework of utilizing futures price, volume, and open interest to create a signal of momentum. So this is usually the conditions used in traditional markets to analyze, to predict price based on these certain conditions. So if the price is rising and the volume is going up and the open interest is going up, is usually a sign of strong bullish momentum, which happens to be what's going on in crypto futures these days. And what we're doing is also applying our machine learning and statistical models to analyze the distribution of these results and essentially make sure that these conditions not only prove that that they go along with the results and adapt the model so that we provide bullish or bearish signals depending not only on this, but on what the actual data is showing. So I mentioned earlier how Binance currently, for Bitcoin specifically, 75% of their trading volumes are in futures contracts. And we believe that there should be a way to track the market share, sort of, that these futures or derivatives as a whole encompass of the total crypto sphere. So similar to Bitcoin dominance, we're coming up with a futures dominance indicator, which consists of a ratio of the total volume traded for all futures contracts of a token over the total volume of the underlying token. So we would be calculating it per exchange and ideally also for the entire market, given that there's definitely issues with wash trading. So that's been our main issue implementing this formula, sort of speak, this indicator. So our engineering team is currently working really hard to decide how we can apply this and how to track essentially the growth of futures representing that futures represents as a whole of the market. So additionally, other than futures dominance, we're coming up with the weighted funding rate. So it's essentially a measure of the funding rate applied to all the open interest contracts, all the futures contracts. Essentially, we're weighing the funding rate in each exchange by the open interest, not the volume. So this also avoids, first, it avoids the issues with wash trading, which is usually just opening and closing a contract right away. And also, since the funding rate is only charged to those holding the open positions, we would be weighting it and obtaining a better gauge of how the market is positioned long term. And we're building it such that it will be used as an indicator, so you can track how it goes through time. But also, as I said before, applying our machine learning and statistical frameworks to build a signal, ideally, that would be able to show our users if it's bearish or bullish, indicating the positioning in the market. And another aspect that I mentioned that we have been looking at closely into the blog is how do we combine these two things? So how do we combine on-chain data with what our futures analytics are telling us? So far, we've been looking at all of these pieces, and we've found that there's definitely interesting insights that can be applied to miner behavior, trader behavior, market manipulation, and in reality, there's other interesting patterns that our users will be able to discover once we provide the data to them. So let's start with mining. What does futures have to do with mining, you may be wondering? Well, futures actually has been very popular, and derivatives overall, for miners, because remember that miners get paid in Bitcoin, in the case of Bitcoin, or whichever cryptocurrency they're mining. And as they expect volatility, and as prices change, they can often use contracts, short contracts, to hedge or manage their risk against price drops. So one factor that we have been looking at closely is mining revenues as well as hash rate. But essentially, we believe that there's an inverse relation between mining revenues and expectations of mining revenues and futures open interest. So as you may know, the Bitcoin halving is approaching mid-May or early May, sorry, and mining revenues along with Bitcoin issuance will drop in half. And as a result, we expect open interest to continue increasing especially if price stays the same, as more miners hedge their risk of holding Bitcoin and earning less Bitcoin. It says, are you guys hearing me correctly? It says my internet connection sounds stable. Okay, I'll just continue. You're good? Okay. Another thing that we're looking at is the essentially open interest for futures that do expire provides a provides the amount that will be settled by expiration. So for front-running contracts, there's usually billions of dollars, especially for non-traditional markets, that will expire by a certain date. So, that shows us what we're trying to estimate is the impact that we can expect from those contracts settling. So we're combining that with our in and out of the money indicator. So we recently launched this in and out of the money indicator around current price. And here you can see that people that might have bought around this price range. So it's data for yesterday. But regardless, as you may have known, there was a large resistance around this price range. And it's because, and partly it's because holders that bought at these prices might be looking to break even around this price range. And we're trying to compare these two, building a standout indicator that will essentially combine the two to predict the impact that we can expect from prices at the expiration, indicated by the futures price, and taking into account the resistance provided through positions that are out of the money in the blockchain. So another factor that we can look at, and it's definitely been a hot topic and controversial in Bitcoin market specifically, is market manipulation. So essentially, the way market manipulation is done is usually a buyer can go to a spot exchange, most of which are unregulated, and before expiration date, they might decide to buy a large amount of Bitcoin or sell a large amount of Bitcoin to push the price of the underlying asset, Bitcoin in this case, towards their desired level in the futures exchange. And we have looked at data closely to analyze if there's a constant market manipulation. And our conclusion so far is that there tends to be some correlation, but not necessarily causation, that the futures expiration dates implicate manipulation. Also, we have seen this both on the long side and the short side. So there's no constant pattern. And even though we do see sometimes spikes in large transactions preceding contract expirations, there's no clear proof completely of market manipulation. And what we decide to do, our approach to this, is to provide the data and users be able to draw their own conclusions based on the data that we provide. Other indicators that we're looking to launch with our future release is the futures price range. So essentially the low and high prices for the day or 52 weeks. The index spot prices, of course, volume open interest, and the settlement dates. So here is where you'll be able to track within Into the Block when a contract is expiring and compare the data with the rest of our countless indicators of network and financial indicators in the blockchain, and see if there's patterns that arise as the contract is approaching expiry date, as well as some of the ones that I already mentioned before. So yes, we're excited. Our team has been working really hard analyzing and implementing the solutions. So we do not collect the data ourselves, and I just got received the questions in the Q&A. We currently have an API with CoinGecko. So they've launched their derivative section. We're currently working with their solution for CoinGecko API. We're also evaluating the possibility, looking at the exchange's APIs, but currently we're using CoinGecko API, which they have been incredibly helpful providing this data. And as well, we'll provide in our launch, we'll provide most of the indicators mentioned, the major exchanges, so you wouldn't be missing out on any. You're going to be having BitMEX, CME, even Backed, even though they don't have large amounts of volume, should be in our launch. And well, yes, that's it. That concludes our presentation. Hope you guys enjoyed. Make sure to refresh CoinMarketCap and see Into the Block in a few hours. So half an hour from now, we should launch. And with that, we wanted to announce our next webinar, which will be on machine learning for crypto assets. Our CEO, Jesus Rodriguez, will be hosting the presentation, and it will be focused on what works for machine learning in crypto assets, what doesn't, and how to do it without going crazy. We hope to see you guys there. Thank you. With that, I open the room for questions. So yes, we will post the video after the presentation, as well as the slides that will be available in the video. We'll just wait a few more minutes, see if anyone has some other questions for the Q&A. So anonymous attendee just asked if we're looking into options. We definitely have a few more questions loaded. Yes, we definitely are looking into options. It won't be in the first release though. Unfortunately, we have noticed that derivatives as a whole started mostly in futures, which is a pattern similar to traditional markets where futures took the lead. So we're currently focused on futures and perpetual swaps, of course. And we're looking to launch options later as we iterate the product. So for XRP, unfortunately, we wouldn't be able to have the data as of now, just because we're currently integrating with Ripple's blockchain, which is very different from the Bitcoin and Ethereum blockchain. But I believe that once we have it, we should be adding those contracts. And yes, we do not use our website. So anonymous, another anonymous attendee just asked if we use our website to trade futures. No, so we're a data provider. We do what we can to empower blockchain intelligence. So we give you the tools for you to trade, but you wouldn't be able to trade the futures yourself from our platform. Instead, we provide the data for multiple platforms. So similar to our order book section, you will see the data for multiple exchanges, and then you can open a different tab and trade for yourself, essentially. Okay, one more question. Would you consider adding technical analysis, chart patterns in your criteria to determine momentum, etc.? So we have been looking at technical analysis, but currently we believe that there's essentially a significant amount of information available for technical analysis. We want to provide analytics with cryptocurrency being a digitally native product. We have a significant amount of information that's available that has never been available for other products. So we want to focus on the data that's available specifically for crypto assets. So that's why we're looking at combining on-chain components with futures analytics. So at the moment for our futures launch, we won't have technical analysis in our momentum indicators. Instead, it will be focused just on data on the blockchain and data on the futures exchanges. Okay, perfect. No more questions. Thank you very much for your time. Hope you guys enjoyed, and make sure to check CoinMarketCap for inter-block integration. And before the end of Q1, you should see our futures and perpetual swaps product up and running. Thank you very much. Hope you have a great day.